Good evening, everyone. Thank you very much for coming today. It's good to see some familiar faces. My name is Charles Luke, and I'm going to talk about the slightly more serene world of UK equity income and Murray income in particular. I can talk a little bit about sort of the background for Murray income, why you should consider investing in Murray Income Trust. So what I like to call the 3Ds, talk about a few new holdings, and also why you should consider investing in the trust tomorrow. Just very briefly about myself. So I've been investing in the UK equity income space for over 25 years now. I've been the manager of the Murray Income Trust since 2006, and I also manage the Murray Income's open-ended sister fund, which is the Aberdeen UK Income Equity Fund. A reminder of Murray Income. So what we're trying to do is three things: to generate a high income, to grow that income, and to generate some capital growth through investment in a portfolio principally of UK equities. We merged with Perpetual Income and Growth Investment Trust in November 2020. That nearly doubled the size of the portfolio. So we're now at £1.1 billion with 55 holdings. We can invest in overseas listed holdings up to 20%. So that's about 17% of gross assets through 12 companies. The portfolio size split is 25% mid-cap, 75% large cap, gearing around 8%, dividend yield attractive at 4.3%. A discount of around 6%, competitive charges, OCR of 50 basis points, and we're AAA rated by MSCI for our ESG criteria. We're very proud of our 49 consecutive year track record of dividend growth. This year, all being well, will be the 100th anniversary for Murray Income and also the 50th consecutive year of dividend growth. Given the nature of the portfolio, the income generation over the pandemic period has been very robust, more robust than the market. And we also have some attractive revenue reserves equivalent to around 50% of the full year dividend. And I've got a sort of quick question. If you were to think about where you'd want to invest to be confident of another 50 years of dividend growth, what sort of areas of the market, sort of trends or themes would you want to invest in? And you might say demographics or digitalization, automation, net zero. So just make a mental note of some of those trends, please. So Murray Income, this is the 3Ds, the investment proposition in a nutshell. So we want to be dependable, we want to be diversified, and we want to be differentiated. So dependable in the sense of focusing on a portfolio of high quality companies with resilient income and strong capital growth prospects, benefiting from a large and experienced team of investors, and having a patient buy and hold investment approach and letting the fundamentals win through over time. We also want to be diversified, not having all of our eggs in one basket, not being overly exposed to any one economic scenario. So thoughtful diversification in terms of sector and income and capital. As I said before, we can invest up to 20% of assets in the best overseas listed companies. That's helpful in terms of diversifying risk in concentrated sectors in the UK, but also gaining exposure to companies and industries that you just can't find in the UK market. Also diversification in terms of a healthy exposure to mid-cap companies, and we have a modest option writing program that provides an independent, uncorrelated income stream, and also allows us to invest in some companies with perhaps lower starting yields but better capital and dividend growth prospects. And that option program will typically account for about 5% of the total income. And then the final D is differentiated. So we think we're differentiated in terms of the focus on high quality companies, the diversification, the overseas listed holdings, exposure to mid caps, the little bit of option writing, also the strong ESG focus. So the AAA rating by MSCI, there's no tobacco in the portfolio. And when you put all of those factors together, you end up with a portfolio with an attractive dividend yield, which balances capital resilience, but also provides the opportunity for long-term structural growth and has delivered an appealing risk-adjusted returns with low volatility. If you think about what we're trying to do is sort of marry together quality and income. So on the one hand, quality, so structural growth, winning business models, strong ESG characteristics, and on the other hand, income, so which acts as a sort of valuation backstop. It reduces agency risk. It's a touchstone for the health of a company. And you put all those factors together, the outcome is strong long-term capital growth potential, attractive and resilient earnings and income, and low volatility. Now, this slide shows you the quality of the portfolio from a quantitative perspective, and it looks at the sort of standard deviations compared to the all-share index. And in maroon, in the middle, you can see the quality aspects of the portfolio, so high return on equity, high return on invested capital, earnings growth stability. And then on the far right, in the purple, the very strong ESG characteristics. If you look on the left, in terms of value, the portfolio is a little bit more expensive than market. And I think that's probably best explained with the next slide, which shows you the forward PE of the fund in black compared to the benchmark in blue. So you can see over this sort of 5-year period, the fund has been perhaps 2 or 3 PE points more expensive than the market. But you'll see where we are at the moment in absolute terms is low. So the benchmark, the all-share trades on a PE of about 10 times. The fund trades on 12 times. And I'd say sort of 12 times PE for a really great quality portfolio is really not expensive. So I'd just like to talk in a little bit more detail about the 3Ds. So I'll just try and rattle through these slides. In terms of being dependable, this is the UK and European equities team, very well resourced, writing our own proprietary research, excellent corporate access in terms of executives and non-executives, and we have ESG embedded in the team with the appropriately named, you see on the bottom right, Andy Risk and Johnny Salvage, who are our ESG analysts. Nominative determinism there, maybe. And then the next slide, just a sort of thought about quality. So Murray Income really works on the very simple thesis that if you want to invest in companies that can grow their dividends over the long term, they need to grow their earnings. And we think that good quality companies are best placed to do that. So quality investing works because the market systematically underestimates the sustainability of returns. Good quality companies have fewer tail risks, greater margin of safety. They produce less volatile earnings streams. They're actually more likely to deliver on their earnings aspirations. And because of that, they're actually more likely to deliver on their dividend aspirations. And along the way, you get special dividends because balance sheets tend to be stronger. And they're much better placed to navigate uncertain times. And when we do our research, when we think about quality, we grade each company from a Q1, which is the best quality company, to a Q5, which is the worst quality company. And in Murray Income, we'll only invest in a company which we think is a Q1, Q2, or a Q3 business. And when we're thinking about quality, we're looking at the sustainability and durability of a company's business model and moat, the attractiveness of the industry, strength of financials, capability, track record of management, and the ESG risks and opportunities. Now, this slide hopefully provides a little bit of empirical evidence that why you would want to invest in a good quality company. So it takes, unfortunately, this isn't entirely the portfolio of Murray Income over the last 20 years. I wouldn't be standing here probably if it was, but what it does show you is the top 20 best performing companies in the market over the last 20 years. From the ones at the bottom, so they've only gone up 20 times, the ones at the top, they've gone up over 100 times. And what I've tried to do is find a quantitative measure for the quality of these businesses. So taking the 10-year median return on invested capital. And if a company can maintain a return on invested capital above its cost of capital, say the company's cost of capital is 6, 7, 8%, and it's able to retain a return on invested capital above that level, then it has some sort of sustainable competitive advantage, or in other words, it's a good quality business. And you can see that many of these companies have been able to do that. And I think another couple of interesting points about this slide is that these top performing companies, they're not grouped in any particular sector. They come from right across the market, which talks to the benefits of having a diversified portfolio. And also, it's not easy to divine any macro influence on these companies. So if you take Dechra Pharmaceuticals, if interest rates have been higher, inflation had been lower, sterling had been stronger, would Dechra Pharmaceuticals be selling less companion animal medicines? It probably wouldn't have made much difference. And I think that's summed up by the quote on the bottom in the bullet point, and actually in Warren Buffett's shareholder letter this year, he actually used this quote from Benjamin Graham, and it said, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. So really important to invest in good quality businesses that can grow their earnings over the long term. Diageo, an example of a core holding. So Diageo is 5% of Murray Income. We like it for its strong, well-known brands, its leading products across different categories and price points, and attractive geographic exposure. Long-term drivers, premiumisation, spirits taking share from beer and wine, population growth, and also high barriers to entry as well. No slide presentation would be complete without a quick slide on ESG. So this is an example of NMC Healthcare, which was a darling of the stock market until a couple of years ago when a giant fraud was discovered and the company is now worth zero. And when we were doing our analysis of the company and thinking about the governance of the business, we looked at the audit committee, and the audit committee meant to be staffed by 3 independent non-executive directors. And what we discovered was very concerning, because the chairman of the audit committee, he had very little financial experience. He was touted as a financial communication specialist. But if you looked on Companies House, you would have seen that his financial communications company had just been dissolved, having changed its name 5 times in the previous 10 years. Not necessarily the person you'd want to be the audit committee chairman of a FTSE 100 company. The second supposedly independent non-executive director was a director of a company that was controlled or owned by the founder of NMC, who was also the chairman, and he wasn't independent. And this wasn't reported in the annual report, and it clearly suggested a conflict of interest, and that the second director was not independent. And the third non-executive director, who was also deemed to be independent, she'd set up her own company with the chairman of NMC to invest in other healthcare companies in the Middle East. And clearly this wasn't reported in the annual report either. And she also said in a newspaper interview how proud she was to sit on the board of 20 other companies, which sort of takes overboarding to a whole new level. And we also had concerns about the auditor, EY, as well. And at the time, everyone gave this company a vote of confidence. It was a darling of the stock market, but we had some very, very serious governance concerns. And a company like NMC would never have made it into the Murray Income portfolio. So I just talk a little bit about diversification. So this is the diversification in terms of capital, so not wanting to be overly exposed to any one particular economic scenario, not having all our eggs in one basket. So on the left-hand side, you can see the diversification in terms of sector on the pie chart, and on the right-hand side, the 10 largest portfolio positions. And as a rule of thumb, I'm not keen on having more than 5% in any one particular company. And then in terms of income, a very similar picture, so diversification of the income by sector, and then also by individual company on the right-hand side. And I mentioned being able to invest in overseas listed companies. So the benefits of that are helping to diversify risk in concentrated sectors in the UK market, but also gaining access to new industries that you can't find in the UK. So Novo Nordisk has been in the portfolio for 5 years, leading position in diabetes care and increasingly in obesity care. Again, lots of structural growth drivers, high barriers to entry, and some very strong quality characteristics in terms of high gross margins, very profitable business, strong earnings growth potential, excellent returns, and a very strong balance sheet as well. In terms of being differentiated, so clearly lots of UK funds, lots of UK equity income funds that you can invest in, but we think Murray Income is differentiated, and at the centre of the slide is good quality companies, and that's really at the heart of what we do. So differentiated in terms of the focus on good quality companies, but also the mid-cap exposure, that little bit of option writing, the overseas holdings, ESG focus, so no tobacco, AAA rated by MSCI, the diversification in terms of income and capital and by sector. We have a conservative patient buy and hold investment approach. So turnover is normally about 15% a year, strong long-term performance track record, and resilience in market drawdown. So we tend to outperform when the market goes down and keep up when the market goes up. And then coming back to my earlier point about areas of the market that you'd want to invest in to hopefully generate another 50 years of consecutive dividend growth. So all of these companies are holdings in the portfolio. So aging populations, or digital transformation, or energy transition, or emerging global wealth. And I think very few UK equity income funds would have this range of companies dialed into these themes. So in terms of performance, strong performance over the long term, particularly on a risk-adjusted basis. For 2 out of the last 3 years, we won the Citywire UK Equity Income Investment Trust Award for our risk-adjusted returns. Over the shorter term, value has performed well, so that's been a headwind for us. But we're very confident about the portfolio's ability to deliver long-term outperformance. These numbers go to the end of February. We outperformed by about 2% in March. The market was weak in March. We tend to do better, add alpha when the market goes down, and that is explained by this slide, which goes back 10 years and looks at the relative returns of the portfolio in up markets and down markets, and you can see that when the market goes up, we perform in line, and when the market goes down, that's when we tend to deliver outperformance. Since the company's year end, which was the end of June, we bought 4 new holdings. So just to briefly talk about these, so LVMH, the leading global luxury goods company, high quality attributes, and provides exposure to a market segment that you can't really find in the UK, apart from perhaps Burberry, which is a sort of single brand, but LVMH has a plethora of luxury, very well-known luxury brands. We also bought a small position in Roche, the Swiss pharmaceutical company. Helps to diversify risk in concentrated sectors, such as pharmaceuticals in the UK. Our company has a strong R&D track record, a very long-term perspective, and a strong balance sheet. Also bought a new holding in Games Workshop, the fantasy tabletop war game company. Strong intellectual property through its Warhammer series, very high customer loyalty. I went to visit the company in Nottingham 3 weeks ago, and they're very excited by the potential TV series on Amazon and what that could mean for demand. And then the final, most recent purchase is Genus, the animal genetics company. They're working on a PRRS virus-resistant pig, and if that is successful, which it looks like it will be, then that could be very significant in terms of their long-term earnings growth potential. And then in terms of why now, so UK equity valuations remain very attractive. You saw the market trades on a P of around 10 times, portfolio on 12 times. If you compare that to other regional equity markets, adjusting for sectors, however you look at it, the UK market looks good value. It has access to global growth opportunities, some excellent companies with strong competitive advantages, world-class standards of corporate governance and IP protection. There wouldn't appear to be a democracy premium in the UK at the moment. And international investors are underweight. And significant opportunity for M&A, and we actually had a bid. We have a small holding in Industrials REIT that was bid for yesterday by private equity, and it wouldn't surprise me if a sizable majority of the portfolio has the potential to be bid for by private equity or other companies. And then in terms of why equity income, so dividends are a key driver of long-term returns, obviously serve an important functional purpose as well. Dividends in the UK market have been rebased, payout ratios are at sensible levels. But I think what's really important is to focus on companies that are able to generate sustainable dividend growth, not just looking at high yields, companies that can grow their earnings and therefore can grow their dividends over the long term. And then in terms of the final slide, so a summary, so 3D, so we want to be dependable, focus on high quality companies, resilient income, strong capital growth potential, the benefits of the large team, taking a conservative approach, letting the fundamentals win through over time, diversification, not having all of our eggs in one basket, not being overly exposed to any one particular economic scenario, so diversification by sector and income and capital, that investment in overseas listed companies to help diversify risk and gain access to industries that you can't find in the UK. We have 25% of the portfolio invested in mid-cap companies. We have that little bit of option writing, helpful in terms of an uncorrelated income stream, but also allowing us to invest in some of those companies that you would have seen on previous slides that have perhaps lower starting yields but better dividend and capital growth prospects. And then the differentiation. So the focus on quality, diversification, overseas listed holdings, mid-cap exposure, the option writing, the ESG focus, no tobacco, AAA rated by MSCI. And then putting all of that together, the attractive dividend yield, 4.3%, the resilience in challenging markets and the long-term structural growth potential, and the appealing risk-adjusted returns with low volatility. Or maybe to sum that up more concisely, the company was given a buy rating by the Times last month in the Tempest column, and they said a reliable dividend and trades at a discount. So those 2 points are important as well. Thank you.
Thank you very much indeed. Thank you. Just before we get going on questions, you mentioned discount there. Can you comment on what the discount is and the normal range that it operates in?
Yeah, so the normal range is about 5 or 6%, and it's around 6% at the moment. It did spike out to about 12% in October. It didn't stay there for very long. The company has been buying back shares. That policy isn't public, but if you were to look at where the buybacks have taken place, it would be around about the 6% level.
Thank you. Any questions for Charles, please? Thank you. Yep.
Yes, thank you. 2 questions. The first one is, how much churn do you have in your portfolio? And by that I mean, do you rotate sectors quite actively during the year, or do you rather go for long-term trends? And the reason I'm asking that is I saw that in the top 10 holdings you have, there are quite a lot of cyclical companies in there, oil and metals, and they typically go up and then retrace for long periods and then may go up again, as we're seeing these days. So that's my first question. And my second question is more on the option writing, if you could elaborate a bit on that, and also whether or not you're looking at other types of options, like longer dated options and so on. Thanks.
Yeah, sure. So in terms of churn, as I said, turnover is around about 15% a year. And we want, if you look at, if you take oil and gas and mining together, so the way I sort of tend to think about it is they're not perhaps the greatest quality businesses, and they're not fantastic from an ESG perspective. But the companies that we do own, we think are most dialed into the energy transition and have the best ESG characteristics. But the benefits they do give are in terms of diversification and in terms of yield. So they're long-term holdings. We're not trying to call a cycle, but we're trying to gain a little bit of diversification and yield from owning those companies. In terms of the option writing question, fortunately, I have a slide prepared for that. And so, as I said, the rationale behind this, and we've been doing this for just under 15 years, is to provide an additional uncorrelated income stream and to allow us to invest in those companies with really strong capital and dividend growth potential, but perhaps lower starting yields. So that gives us some headroom to do so. All the options are written on a fundamental analysis basis. So there's no option overlay, there's no systematic option writing. So an example would be, so AstraZeneca is maybe 5.5% of the portfolio. My rule of thumb is not having more than 5%. I write a covered call, so all the calls are covered, and 90% of the options are covered calls, 10% are puts, for which we need to have the cash. But AstraZeneca, the option is written maybe 5% above the current share price. So if the valuation is a little bit more expensive, the share price goes up, then we reduce the holding in AstraZeneca marginally, brings the weight down, and in return for that, we gained a little bit of an option premium, which we can use as income to distribute to shareholders. And at any one time, perhaps 2% of the fund is overwritten, maybe a couple of puts as well. Typically, an option is written 5% out of the money over a 1 to 3 month duration. It's written over a range of different companies. And actually, I mean, the board really like the option writing program and think we should make more of it. And it's worked very well for the last well over a decade.
What's your attitude and policy to paying dividends out of capital?
Well, so when we merged with Perpetual Income and Growth, we asked shareholders for the ability to do so, and they approved. But I maintain a sort of 5-year dividend forecast, and I can see no reason whatsoever why we would need to pay out of capital. And particularly, we have revenue reserves that we've used, I think, 6 times in the last 49 years. So that does provide a little bit of a cushion. But last year, we generated 40.5 pence of earnings, and we paid out 36p in terms of dividend. So we're not needing to pay out of capital.
Question here, please. Yeah.
2 questions. You said what you've bought. Can you tell us what you've sold in the last 12 months?
Yeah.
And also, I think you said that gearing was 8%. Do you plan to increase it?
Yeah. So we think about gearing in terms of a very sort of long-term strategic, way. So it's very, very infrequently changed. It just helps to gently amplify returns over the long term. So no plans to change that. But obviously, if the value of the asset changes, then the gearing will move as a consequence of that. But we don't increase or decrease the absolute level of borrowings. And then in terms of what's been sold over the last 9 months or so, we benefited from a number of takeovers. So Euromoney, we had a holding in Euromoney that was sold. Countryside Partnerships was sold. We did quite a lot of work. Well, we did a lot of work on the implications of higher interest rates on some of the property companies and the impact in terms of higher cap rates and the risks in terms of higher interest charges and the ability of some of the companies in the real estate sector to maintain or grow their dividends. And we were a bit concerned about that. So we sold a holding in Assura and Sirius Real Estate. And we had, to be very candid, we had a very small holding in Watkin Jones. And in October, with the quasi-Kwarteng budget, the increase in bond yields, what we thought was a good quality company because it had got through COVID very well. It had a net cash balance sheet. It was exposed to some very attractive long-term growth areas. That quality argument wasn't as strong as we thought it was because they had some delays to some of their projects and they were reliant on a relatively few projects. So we had a 45 basis point holding in Watkin Jones, and that would have been very difficult to justify as a good quality company after it had a profit warning. So we sold that as well. So those are some of the holdings that we sold.
Any more questions for Charles, please? Thank you.
I may have missed something on your chart, but you were showing a 5-year growth of 38.4%. Is that a total income, or was, in other words, dividends on top, or is that purely the capital growth?
That is the NAV, total return per share on an NAV basis.
So that's the net asset value increase, and as an investor, one would have had the dividends on top of that, giving a net.
Well, as an investor, you would have had the share price return, so that would have been 42 just over 42.5%, which would include dividends reinvested.
Okay, so that's with dividends reinvested.
Yeah.
Okay, thank you very much.
And I had a question on Games Workshop. It's been quite a high-profile company for a number of years, and you bought in recently. Did anything change in particular that made you think now was the time to buy?
Simply the valuation came back to a level of around, just under 20 times earnings. So it had been on the radar for a long time, but the valuation had always been quite expensive. So we were actually relatively fortunate in terms of the timing, because bought the shares, and then about 3 weeks later, they announced the proposal to have this series on Amazon, and the share price went up another 10 or 15%. So that was the timing was fortuitous, but it was the reason for doing so was the valuation came back within the range.
Another question I had was about the international, the overseas holdings. Is that also managed by your team? The broader team you showed there, is that a different part of Aberdeen that looks after that for you?
Yeah, so that's also managed by myself and the team, and most of the holdings are European. We have 3 holdings outside Europe, so Microsoft, OCBC in Singapore, and a Taiwanese company called Acton Technology. And one of the benefits of Aberdeen is that we have lots of regional equity teams who all have the same process. So they're all writing notes, looking at quality. And when I'm sort of thinking about these companies as well, I can talk to Yu Jong-oh, who manages the Asian Income Fund. I had a chat the other day with Bruce Stout and Murray International about OCBC. So we've got lots of expertise within the company and lots of different fund managers to sort of think about different opportunities outside the UK and Europe.
But it's still you at the end?
It's still me, yeah.
Look, Charles, we've got one more. Our time is up, but we've got one more. You go.
So you said the share price there of the 42 is with dividends reinvested?
Yeah.
Is that the same for the FT?
Yeah, the FTSE All Share
So the
Index will also...
28.9 for 3
Yeah.
years has got dividends reinvested as well?
That will also have dividends reinvested,
Thank
total
you.
return. Yeah.
Charles, thank you very much indeed. That's been really, really interesting. Thank you.